SpaceX just became a public company a couple days ago. And 4 days later, Elon Musk used that public stock to buy a $60 billion AI company that's losing market share. Now, most investors are still looking at the IPO, watching the chart, seeing how high or low it can go. But I think they're looking at the wrong thing, guys. Because the real trade isn't the IPO. It's what happens between now and December. And by the end of this video, you will know exactly why. So retail investors waited years for this moment. And on June 12th, SpaceX finally hit the Nasdaq at $135 a share. The stock exploded. Within days, it traded as high as $225, briefly pushing its market cap above companies like Microsoft and Amazon before settling back around 205, and I think this morning it's down around 196. That is roughly a 50% move from the IPO price in just 3 trading sessions. And while everyone was celebrating, finally getting access to SpaceX, management immediately made a decision that changed that entire investment story. A $60 billion all-stock acquisition of Cursor. Not cash, stock. Which means the very shares investors just bought became acquisition currency overnight. And that's the question sitting in front of every SpaceX holder today. Did you buy into a generational aerospace and AI platform? Or did you buy the financing vehicle Elon Musk is now using to build one? So let's start with the number nobody can seem to agree on. SpaceX came public at a valuation of roughly $75 billion. And 3 days later, the market was valuing the company at approximately $2.6 trillion. Think about that for a second. Morningstar's fair value estimate sits at just $62 per share. The stock is trading around 196. That's about 3 times Morningstar's estimate of intrinsic value. The street consensus is roughly higher at 164. But even that target has already been exceeded by 25%. And remember, we are talking about a company with almost no trading history. And now add the Cursor acquisition, right? SpaceX is buying Anysphere, the company behind Cursor, for $60 billion. And that deal is entirely done with stock. No cash, no debt, just SPCX shares. The final exchange ratio won't even be known until the transaction closes because it's based on a 7-day VWAP leading into the completion, which is expected sometime during Q3. So that means Cursor investors don't know yet how many SpaceX shares they will receive. And existing SpaceX holders don't yet know exactly how much dilution they'll be absorbing. So if SpaceX keeps climbing, fewer shares will get issued. And if the stock falls, more shares will get issued. That's the key mechanic. And here's the part that should make investors pause. Cursor's market share has reportedly fallen from roughly 41% last June to around 26%. The company raised more than $3 billion across previous funding rounds, yet reports suggest it still wasn't even close to break even. So SpaceX is effectively spending $60 billion of public shareholder equity on an AI asset that's losing share and still burning cash. That's the setup we need to be looking at. And understanding that setup matters a lot more than understanding the IPO headline. Because valuation isn't actually the biggest risk here. The lockup is. And that's where this trade gets interesting. So if you're looking at SpaceX as a trade, this isn't an earnings play, right? It isn't a weekly options trade. This is a position trade built around one very specific date, December 8th, 2026. That's when the standard 180-day lockup expires. And suddenly, insiders, employees, venture investors, and pre-IPO holders gain the ability to sell. And at a $2.6 trillion valuation, that is not a small event. That is potentially a massive supply event. And now let's break down both sides. Because if you're bullish, your thesis is straightforward. Starlink will continue to scale. Launch revenues continue to grow. The Cursor acquisition accelerates the AI strategy. And investors decide SpaceX deserves a premium multiple because it's building businesses across aerospace, communications, and artificial intelligence simultaneously. In that world, December becomes a temporary dip rather than a structural problem. But if you're bearish or simply hedging, the cleaner expression may be a long-dated put spread. Something like buying the January 2027 170s and selling the 140s. You're not betting on a collapse, but you're betting that lockup selling and multiple compression pull the stock back toward the street consensus range over the next 6 to 8 months. Maximum loss is the debit paid for the spread. Maximum gain, the spread width. And for investors lucky enough to receive IPO allocation shares, you may already be sitting on a 50% profit. In that situation, covered calls become extremely interesting. Implied volatility on a brand new IPO with this level of retail attention is elevated. So selling premium against the position while the story develops is a reasonable way to monetize that volatility. So now let's talk about what actually happens next. Because from here, there are really only 3 paths that I see. And the third one is a scenario that most SpaceX buyers haven't considered at all. So number 1, the bull case, guys. Cursor works, right? The acquisition, it works. The AI coding market expands. The integration with XAI and Grok creates a vertically integrated AI ecosystem capable of generating meaningful enterprise revenue. Starlink keeps scaling, launch revenues compound, and investors eventually decide that a $2.6 trillion valuation wasn't aggressive enough. In that scenario, the lockup selling would simply just get absorbed and any weakness would get bought. SpaceX would remain above 200 and push toward 250 by year end. The long holders would stay long, and covered call writers simply keep rolling strikes higher. The base case, though, is the deal closes. The dilution math gets priced in and the excitement fades. SpaceX would spend the summer drifting between 160 and 200. Still expensive, still trading above consensus, but no longer benefiting from the IPO euphoria. Morningstar's valuation estimates and street targets become gravitational forces, and the lockup remains an overhang. Early buyers would take profits, and the stock would enter a long period of consolidation. Of the 3 outcomes, this is probably the most likely. Not a full-on collapse and not a moonshot, just a premium stock trying to justify a premium valuation. And the bear case, guys, right? This is where things get uncomfortable. SpaceX reported a consolidated net loss of roughly $4.9 billion during fiscal 2025. That's a reversal from profitability in 2024. And much of that deterioration was tied to XAI integration spending. Now imagine the first public company earnings report arrives. The AI spending remains elevated, and the returns aren't visible yet. Investors would begin questioning the economics of this. And at the same time, lockup selling hits the market. That's when multiple compression and supply pressure arrive together. In that scenario, SpaceX could trade back towards the $130 to $150 range, potentially even below the IPO price. And that's the risk most investors chasing the IPO run haven't spent much time thinking about. So before you touch this trade, there are 3 risks we need to understand. Number 1, the lockup expiration. December 8th is the known, the magnitude is not. We don't know how many insiders are going to sell, and we don't know where they'll sell. We also don't know whether the market will fully price it in beforehand. But make no mistake, this is a real supply event, not a hypothetical one. Risk number 2, guys, is cursor dilution. The final share count is still floating because the acquisition uses a 7-day VWAP prior to closing. So if SPCX rises, dilution falls. And if SpaceX weakens, dilution will increase. So between now and Q3, the stock itself partially determines how favorable the deal becomes for existing shareholders. And risk number 3, right? This is a brand new public company. There's no meaningful chart history, no established earnings track record as a public entity. Very few technical details and technical levels that matter. And while options can provide protection, implied volatility is elevated enough that protection is not cheap. Every hedge comes with a cost. So make sure you understand that cost before you put one on. Now guys, this was not financial advice. Options trading involves significant risk and is not suitable for all investors. So as always, do your own research before placing any trade. And here's my question to you before we close. Are you holding SpaceX through the December lockup, or are you treating this as a short-term trade until the supply event arrives? Drop your answer down in the comments. This is Luke with the Option Bomb, and I'll see you in the next one.